Hey, how's it going? In this video, I'm going to be talking about equity. Equity is often referred to as equity in the context of financial accounting. It's a fundamental concept that represents ownership, interest in a company, or the residual value of an asset after all of its liabilities have been subtracted. It's a key component of the company's balance sheets and provides insight into financial health and value of the business. Key points: equity in business context. In the business context, equity represents the ownership stake that shareholders or investors have in a company. It is calculated by subtracting the total liabilities, such as loans or debts, from the total assets of the company. The remaining value, which belongs to shareholders, is equity. Components of equity. Equity on the company's balance sheet is typically divided into several components, including share capital, value of shares issued by investors in exchange for ownership, retained earnings, the accumulated profits or losses that company has retained over time, additional paid-in capital received from shareholders that exceeds the par value of the company's stock, treasury stock, shares of the company stock that have been repurchased and are held by the company itself. Ownership and voting rights. Shareholders who hold equity in a company have ownership rights and may be entitled to vote on certain corporate decisions, such as election of the board directors, the number of shares shareholders own typically determine their level of influence. Return on equity. It's a financial metric that measures the profitability of the company in relation to its equity. It's calculated as the net income divided by shareholders' equity, and it's often used by investors to assess a company's financial performance. Equity financing. Companies can raise capital by issuing shares of stock to investors. This is known as equity financing. It provides companies with funds in exchange for ownership stake, and investors become shareholders with claim on the company's assets and profits. Valuation. Equity is a key factor in determining the value of the company. Market value of the company's equity, often represented by its stock price, reflects investors' perceptions of the company's future earnings and growth perspectives. Risk and reward. Equity investors take on higher level of risk compared to debt holders, bond holders, because they are not guaranteed fixed payments and are exposed to the ups and downs of the company's performance. However, they also have the potential for higher rewards when the company succeeds. In summary, financial equity represents ownership of the company and its critical elements of company's financial structure. It reflects residual interest in the company assets after accounting for liabilities and plays a central role in financial analysis, investment decisions, and corporate finance. Let's take example at this concept. Example company ABC. Suppose we have financial company called ABC Inc., which manufactures and sells widgets. Let's examine its financial situation as of the end of specific year. Total assets are $1 million. Total liabilities $600,000. Now we can calculate financial equity of ABC Inc. using the formula equity equals total assets minus total liabilities. In this case, equity is 1 million minus 600,000 equals to 400,000 dollars. So the equity of ABC Widgets Inc. is 400,000. This means that the owners of ABC, which could be shareholders or investors, have a collective ownership stake in the company value at actually minus all liabilities from 1 million, it equals to 400,000. If the company were to be liquidated, its assets sold, and its debt paid off, the remaining 400,000 will be distributed to shareholders. Furthermore, this equity represents a source of capital that can a company be used for various purposes, such as funding growth, making investments, and paying the dividends to shareholders. It's a crucial indicator for financial health and the state of the company. As the company continues to operate and generate profits, its equity may increase over time. If it retains earnings, profits, and doesn't distribute them all to the shareholders as dividends. Conversely, if the company incurs losses, its equity may decrease. Investors and financial analysts often pay close attention to a company's equity position because it provides insights into financial stability and its liabilities to weather financial challenges or take advantage of opportunities for growth. Hey, I would like to share my book journal for anyone who is interested. It's more interactive than a book since you would be using it as a learning material every single day. If you will keep a track of your routines and optimizing your time, making most of it, that would be something that I would highly recommend for everyone to do, especially taking a look at the key areas. Some of those areas would be self-improvement, taking care of particular tasks across the day, dictionary, finance, perhaps motivation, values, and some of those areas to finding a balance. What of those values would be physical activity, hydration, overall reflecting and learning every single day. Just some of the areas that I would highly recommend for everyone taking a look at. You can find this journal in the description below on my company's website or top retailers. Why it's important to understand equity. Understanding equity will help you with making better financial decisions for individuals, investors, and business. Understanding equity is essential for making informed decisions. It overall helps in assessing financial health of the company, evaluating investment opportunities, and determining value of assets and liabilities. Investment analyze equity is a fundamental factor in investment analyze. Investors use metrics like return on equity and price to earnings ratio to assess the performance and valuation of companies. Understanding equity is vital for making investment decisions and managing investment portfolios. Corporate finance. In the world of corporate finance, equity plays a central role in capital structure decisions. Companies must decide how to balance equity and debt financing to optimize the financial structure, cost of capital. Equity financing throughout stock issuing is a company way to companies for raise funds. Overall valuation, understanding equity is crucial for valuating business, assets, and investment opportunities. Risk assessment, equity is associated with ownership and representments of claims on a company's assets and earnings. Legal and regulatory compliance in legal contexts such as contract laws and business laws. Understanding equity is important for ensuring compliance with fairness and transactions. Social and economic equity in the broader societal context. Understanding social and economic equity is essential for addressing issues of fairness, justice, and equal opportunity. Real estate or property, understanding home equity is crucial for home owners and property buyers. Educational and career opportunities, understanding equity in education and the workplace is essential for promoting equal opportunities and addressing discrimination. Ethical consideration in ethical discriminations and decision making. Equity is often a guiding principles. Overall, thanks for watching and see you next one.